All right, so we're spending a lot of time in Europe and here in the U.S. talking about this jobs number revision. Is that something that you're talking to clients about the potential for it to be a market mover? Do you see it as a potential market mover?
It's unlikely to be. I mean, it is a backward-looking report, as you said. It's just showing you the changes that could happen up to March earlier this year. So it doesn't change the picture of where we are now. It may well add to the Fed's picture of more of an underlying labour market weakness, which would simply reinforce the fact that they need to start cutting rates from next week. But that is pretty much baked in. The market is already fully pricing in a rate cut for next week. So I don't think it's going to change the narrative too much unless it's such a big surprise that you're getting over a million 1.2 revision to jobs. So it's unlikely to move markets today.
You're saying this is an outside move above even the estimates that we just mentioned, Bank of America at 1 million. You're saying it's above that potentially, but not really. I just want to make sure I'm capturing what you're saying.
Yeah, exactly. This is quite backward looking. So it's not telling us anything about what's happening today. And the numbers that you're already being expected, I think the consensus sitting around 600 is already really meaningful. So you need to get much above that in order to move markets.
What are the markets telling us right now? The NASDAQ at a high, the S&P within, I believe, about 0.5% away from its own all-time high, and gold at an all-time high as well. Generally, gold is seen as a safe haven where you're seeing a lot of geopolitical or economic turmoil. What do you make of the major indices here in the U.S. higher along with gold?
Yeah, it's definitely a really interesting picture right now. And the very big move downwards in bond yields that you've seen in the last couple of days is really about the market starting to pricing more and more Fed cuts for the next 12 to 18 months or so. For the equity market, what they're seeing is that, yes, the labor market is cooling. We see that very, very clearly. But the rest of the economic data is actually still fairly resilient. So what the market is saying is that, look, the Fed is going to come in. It's going to provide that additional support to the economy. And you should see this continued economic growth, which should lead to continued earnings gains and therefore keep pushing up the market. So that's what the market is pricing in. But you can see, as you pointed out, gold is at a record high. So there's a much bigger risk scenario out there after that labor market report, with more and more people starting to say, could we be looking at potential recession for next year?
I want to focus on the U.S. markets for a minute. A lot of notes out yesterday saying they see a lot of upside in financials with the idea that we are going to get that rate cut. We're going to continue to see a steepening of the yield curve. Do you see a lot of opportunities in financials? If not, what sector are you seeing as potentially having the biggest upside if we are genuinely going into a rate cutting campaign, or at least a cut coming up in a few days?
We do like financials. I think it's a very valid way to think about it. But look, we continue to expect economic growth through 25 and into 2026. As you said, a steeper yield curve with continued concerns potentially about inflation, fiscal debt pushing up that long end. And that's typically a period where the financial sector can continue to perform well. So we do like financials. Other parts of the market that we like too, if you think about areas, of course, technology continues to be that safe haven almost within all of this controversy, with investors really looking for big balance sheets, cash flow, and that's what tech is providing you. And then remember as well that if you're going to get Fed cuts and that drives a bit of an economic rebound next year, that's really a period where consumer discretionary can perform pretty well. So I think there are a lot of opportunities right now. Of course, you're going to be looking at high quality companies, those that have got pricing power, can withstand some of the headwinds that are coming. But we are still generally quite positive about the market.
You know, Seema, you mentioned controversy. What do you make of what's going on in France right now, that vote against the prime minister there? We saw a lot of money going into Europe. Do you think that this confidence vote and the outcome of it and some of the other turmoil in Europe, is that going to change the money going there? Or if it's going to change going there, does it come back to the U.S.? Does it go to developing markets? Where do you think that money goes?
We've already seen from clients in the last couple of months less interest in Europe. Some of the hopes that were there that had been driving some of those inflows starting to return back to the US. Overall, though, the France story doesn't really change the broader picture for Europe. You know, we are going to see continued fiscal spending for Germany. We know that. We're expecting to see those impacts coming through into the economic data around Q4 and certainly into 2026, which should drive continued optimism. But overall, I think given the run that we've already seen for European markets this year, you're probably not going to see a continuation of that. And it's really about show me the money. Where is the earnings growth going? How are companies going to be performing? So we do think that the gains really now being pushed out to 2026 from here.